Well, good morning, options traders. And here is a great question for the group. How much money do you have at risk for any given position? It sounds like a simple question, but if you don't know the answer, you're not going to know the risk that you need to manage. So let me start by showing you the common thought. Let's say that you buy 100 shares of stock at 50, and over the years you've collected $10 by perhaps writing calls. You've been using a covered call strategy. So your cost basis is now 40 bucks, right? You spent 50, you've collected 10, you've got 40 bucks into it. But now let's say the stock has gone off in a nice little rally and it's been trading for 100 right now. And you decide to enter into a new covered call. So the question is, how much money do you have at risk? Well, if you ask most people, they'll say, well, it's easy. I've got 40 bucks into it, so I have $40 that I am risking in this position. Well, that might be correct from an accounting perspective, it might be right from a tax perspective, but it's absolutely wrong from a risk management perspective. So again, if you're going to manage risk properly, you need to have a new mindset. Understand that the current market price is always the amount that you are subjecting to risk. So using that covered call example, if the stock is 100, you could choose to sell your shares right now for 100. But you're not. By entering the covered call, you're therefore putting $100 of value at risk. So it just doesn't matter what you paid for it. So remember that your cost doesn't matter. It doesn't matter that you've effectively paid 40 bucks for it. You could sell it for 100, and because you're choosing to not do that, you're therefore doing exactly the same thing as if you had gone out and spent 100 for it right now to do that position. So your cost doesn't matter, but the replacement cost does. Now this might sound like an odd concept, but it's exactly why most platforms use what's called a mark to market. They will mark your positions to the current market price. And again, that's what's called marking to market or mark to market. So for instance, let's say that you purchased an option a while back and the current bid is $5 and the asking price is $5.20. Well, the mark is the average between those two. It's just the halfway point. So your broker's platform will most likely show the mark as $5.10. Doesn't matter if you bought it or if you sold it, you should be valuing that position at about $5.10 right now. Doesn't matter if you paid 50 cents for it. Right now, the mark is $5.10. And that's what you need to be understanding is at risk. So again, sometimes this sounds like an odd concept, but it's used a lot in business. It's used in every other facet of life and in business, and yet people get it wrong when it comes to the market. So for instance, think about gas prices. Let's say the station owner pays $2 a gallon, and then you hear that gas prices spike overnight to $2.50. And then you go down to the station and you find out the prices have been pumped up. And people scream to go, hey, this is unfair because the station owner has 2,000 gallons of gas underground here in these tanks that he paid $2 for. So he should only be selling it for $2. It's unfair. That's not true. The reason is that each gallon you buy must be replaced at $2.50. It doesn't matter that he paid $2 for it. It makes no sense for him to sell gas at, let's say, $2, but have to replace it at $2.50. So it's the replacement cost that you have to watch. So again, when you word it this way, still people go, I'm not quite so sure. That sounds like it's a price gouging thing to me. Well, let's turn the tables. Let's say you have a house for sale. You bought a house for $200K and you retire and it's worth $1 million. Well, is it unfair to sell for the market price even though it's well above your cost? And what if a hurricane levels it and the insurance company says, well, we want to settle for $200,000 because that's how much you have into it? Or even let's say that you've been renting out a room over Airbnb for years and you've collected $50,000. So now they say, we only want to pay $150,000 because that's how much you have into it. See, now the tables are turned and you would absolutely scream and say, my cost doesn't matter. It's the replacement cost that counts. And so people tend to understand this when it's used outside of the markets, but they fall right back into the trap when they're trading, and especially for options. I've talked about this example before in previous videos. Who Wants to Be a Millionaire game show. And so contestants get on here and they answer a question for $100. Questions progressively get a little harder and the prizes continue to rise. And so they go through round after round and they keep piling on, let's say, the correct answers. And then finally they get up here to 500,000 and the host says, would you like to go for one more question for $1 million? And I'm always surprised at how many contestants say, well, you know, I came here with nothing. I might as well leave with nothing. That's absolutely false. You have $500,000 at risk because you could choose to walk and put that money in your pocket. But by choosing to stay, it is a $500,000 bet, double or nothing. It is not for zero. It doesn't matter if the money was hard earned by you over decades, or if it fell from the sky, or if it was handed to you within minutes on a game show. 500K is 500K. That is the value of the bet. And I think if more contestants viewed it this way, they'd probably have second thoughts about taking that shot for double or nothing. So another scenario that's very similar to this is, let's say, with mutual funds. People take a long-term investing perspective. They start and they say, well, I only want to put 50,000 into the market. That's what I'm comfortable with. But then they just leave it in there. They don't hedge it. They don't do anything. And over the years, it grows. And let's say it's up to 300,000 now. And then we get hit with something like the 2007-2008 financial crisis or the coronavirus pandemic. And it gets cut in half to 150K. And then they're going, gee, I've now lost 3 times the amount of money that I was really willing to lose. I only wanted to have 50,000 exposed. See, what happened is that you allowed it to grow thinking that there's no risk because you've only got 50,000 into it. And if that's the amount that you're willing to put at risk, you need to find a way to hedge it. That is the key for success in the markets. So always remember, it's your replacement cost that matters. Your cost doesn't matter. The current market price is always the value you're putting at risk. So keep that in mind, and it will help you to make better risk management decisions and also give you some guidelines on when you should be hedging, rolling, and morphing. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.